Reaching the point of trading consistency is the ultimate goal for every trader, and to achieve these milestones, you will need to incorporate three pillars in your trading, which will require finding the market directions, evaluations, the strength of the trend, and efficiency ascending the volatility. Most traders apply three or four indicators to get these information, but at the same time they current their charts. The available solutions for this problem is to Traders Dynamic Index. In today's video we will discuss about the TDI indicator, and I will share to correctly trade with and how to incorporate it in the trading strategy. Traders Dynamic Index is a hybrid indicator that can read the market sentiment, market volatility and movement of the same time. The advantage of its combining the qualities of several indicators into the indicator is what makes the TDI indicators too special. The Traders Dynamic Index is based on three other popular indicators: the RSI, a moving average, and Bollinger Bands. The standard RSI indicator determines the strength of the current trend, or if you want the rate change in price. The moving average algorithms is used to smooth the lines and eliminate RSI false signals, and Bollinger Bands are used to eliminate the amplitude of the oscillators, meaning the volatility. Now let's break down the Traders Dynamic Index indicators. As you can see, TDI has five lines. The green line represents the RSI indicators and represents the market sentiments. It shows you how the market is moving related to positive and negative expectations. The red line is simply a moving average of the green line, meaning a simple moving average applied to the relative strength index and can be used for entries and exits in the market. The yellow line is what we refer to as overall market sentiments. It's the middle Bollinger Bands, and it shows the overall directions of the market. The overall market has the tendency to do two things. It can turn slowly, or it can continue to go in the initial directions. This is because the moving average, usually of the 5-year period, is less representative to quick market change and just slowly. Last but not least, we have two blue eyes on the above and one below. Those blue eyes represent the volatility in the market, representing the upper and lower Bollinger Bands. They are increasing the decreasing volatility. Regarding the calculation procedure, you have several look-back periods you must tweak and adjust. The most important things you must keep in mind is the fact that the TDI indicator is based on the RSI. All lines of the indicator can be calculated on the information of the main RSI oscillators. RSI forms the overall graphic pictures because the main task is to access the rear of the change in the price. A shorter RSI period below 10 with the volatility and will have the lower level of the reliability. A longer RSI period above 20 smooths out to the plotted line and will generate signals that are more accurate. I personally would not use a look-back period below 20 on the RSI. You can also change a period of the moving average applied to the RSI. I don't like using fast moving average below 10, so I would back moving average with 12 or 21 look-back periods. The Bollinger Bands periods must not be lower than the moving average period. If you choose a period of the 20 for the moving average and 20 for the Bollinger Bands, the two lines will become one. I prefer to apply 50 periods on the Bollinger Bands and in some cases even period of the 100. So how to trade with Traders Dynamic Index and what the main signals offered by TDI indicators. First signals the crossover of the green and the red lines. The short-term trend is determined by the related arrangement of the green line in the relations to the red line. The trend is considered ascending when the green line represents the RSI moves above the red line, the moving average. If the green line is below the red line, the market is considered bearish. This is particularly an entry trigger if the green line crosses the signal red line from below, it is a signal to buy. If the cross line the red line from the above, this is the signal to sell. You enter, place the stop loss behind the nearest swing high low, and you take profit at the channels bands, the blue lines, or after the indicator the crossover of the green and the red lines. Now, very important, a crossover of the arrow side, the moving average isn't necessarily an indication to enter trade. In some instances, if the price trend isn't strong, you have multiple crossovers in the short period of time, offering many false signals. Before acting a crossover of the green and the red lines, examine price actions and make sure to identify all major support and resistance points on your chart and make the signals from these key areas. This is very important to take TDI signals from major key levels on your chart. Here are several examples of the valid trades. Second signal involves the crossovers between the red and the yellow lines. The yellow lines in the middle Bollinger Bands indicates long-term trend, and most of the trading time moves the range between the levels 30 and 70, with the exception of suspective momentum. These lines will define key turns for the change in the trend. If the yellow line crosses 30 level downwards and you swipe low code from it markets. A breakaway of the 30 level upwards signals potential reversal or the beginning of the ascending corrections. If the yellow lines rise above 70, the new swing high could form in the market. A breakaway of this level down structures signals is begins of the declining corrections. The global trend is defined by analyzing arrangement of the yellow and the red lines. When the yellow lines is widening down and the red line is below it, the trend is considered bearish. For the bullish market, unit mirror image, the yellow line turns up and the red line moves above it. Again, you don't take crossover signals binary, you take them after you identify the key levels in the market. Here are other examples of the valid crossovers to take. Third, another signal is crossing over 50 levels by the yellow line. This trading signals emerges when the middle Bollinger Bands crosses of the 50 of the arrow side. This is a long-term trading signal, especially if it appears on the lower time frames. If the yellow line crosses the center line from the below, this is the signal to buy. If it crosses the level from the above, it's a signal to sell. To make the signal more powerful, use it combinations with breakouts of the support resistance levels or the lines for the formation of the new price patterns. While many traders focus on the fast moving average, the red line, I prefer to pay extra attention to the yellow line to smooth out the noise of the shorter term price fluctuations. The slope of the yellow line is also important to indicate the strength of the market trends. When it points upwards, the market sentiment is bullish. When it points downwards, the sentiment is bearish. 4. The fourth signal is related to trends and the range of volatility. The TDI indicator also signals the current market trend. We can analyze the relative locations of the Bollinger Bands and the other side line. If the channel bands divergence or expand and the green line forms the strong directions up or down, then there is the active volatility on the market, and the probability of the strong directional movements or the continuation of the current trend is high. The grade and the angle of the green line is the stronger the players in these directions. If the channel lines covers or becomes narrows and the other side lines shows short moments, the market is ranging or is preparing for this stage. The closer the green line to the central line level 50, the less the market is active. So, expansion of the Bollinger Bands signals an increase in volatility. The narrow of the lines on the contrary indicates the decrease in volatility and the weakness market. Fifth signals involves Tdi Regular Divergence. Many trades concentrate on the crossover but neglect an important signals coming from the Tdi Divergence. Oscillatory price makes the new higher heights and the TDI falls to do so. The new highs is TDI is lower than the previous highs. Conversely, sometimes price makes new lower lows, but TDI does not get below the previous lows. The situations are called Tdi Divergence. There is a divergence or mismatch between the information we got from price. The market continues its trend and makes a new extreme. And RSI lines the Tdi indicator. The market first break through the previous extreme, and the trend may changing soon. And hyperbiology signals would be a crossover between the RSI area and the line move average. After the spot divergence, of course, this must occur at an important level of support and resistance. Here are several examples of the divergence Tdi trade. If you learned something new and found value, we would like to show support. Subscribe to our channel to don't miss a new video. Until next time.